Many of you have enjoyed my videos on quality stocks to buy near their 52 weeks lows, and you've asked me to do an update on REITs trading near their 52 weeks lows. And I haven't talked about REITs in a while and dividend stocks in general, but I believe REITs and dividend stocks are having a very interesting setup on a few different fronts. The first one is Jerome Powell's term ending in May 15th of 2026. We're likely going to have some kind of a hawkish or a dovish Fed that's going to be appointed by the President of the United States because they want to lower interest rates. And interest rates will likely come down as we have a new Fed chairman, and this could be a major catalyst for the dividend stocks and for the REITs, which many of the REITs have been flat for the last 4 or 5 years. And I'm gonna show you two of my favorite ones trading near their 52 weeks lows. But if you look at the 10-year, which most assets, including dividend stocks and REITs, they compare them to the 10-year. The 10-year is still at 4.4%, but if you look at month-over-month CPI on the inflation rate, it's back to where it was in 2018. So we're having the same kind of inflation rate month-over-month that we've had in 2018, but the 10-year right now is 4.4%. It's not what it was at 2.9 or 3%. So there is a massive catalyst for REITs, for dividend stocks, with a combination of lower interest rates with lower inflation and a new Fed chairman that could potentially be much more dovish than Jerome Powell, as the president is sincere about lowering interest rates. And it could be, again, a massive catalyst for those stocks. So I'm going to talk about two of them, and I really hope you enjoy it as always. This is the first one which I used to own, and I still have it on my watch list, is Avalon Bay Communities. Avalon Bay is still flat pretty much since 2015. This is one of the best apartment REITs you could own, one of the best highest quality ones, and it's flat from 2015. Now, the reason why I was invested and I really like apartment REITs in general is because they don't dilute stock to create shareholder value. Most REITs, let's say VC properties, they dilute stocks, they issue shares for them to do acquisition. Instead of them taking on debt, they issue shares to do those acquisitions or to pay down the debt, and they dilute shareholders. They still create more value per share, but they do dilute stock. But with the apartment REITs like Avalon Bay Communities or Mid-America Apartment Communities, which I also used to own, amazing company also, you could pretty much see that their shares are almost flat. So they don't dilute stock for them to grow. They mainly renovate apartments, they raise rents, and they build new apartment complexes. And this is how they do it. The company owns 94,000 apartment homes in the United States across 10 US regions, which is over 309 communities in total. Enterprise value of 40 billion, very good credit rating, 4.8% dividend growth since the 2000. It's a very good dividend payer. Now, if we look at the fundamentals of the housing market in the United States, interest rates are high, mortgage rates are high, and it's much more expensive to buy a house than to rent a house. It's been this way for a while, but especially since 2020, home prices have gone up, and now interest rates have gone up. So buying a house is very expensive. Most people cannot afford to save up for the down payment, and they can't even qualify for the monthly payment with 7.5% mortgage rates. So they've been renting much more than they did, and companies like Avalon Bay Communities have been experiencing decent growth, and I believe this is a tailwind that's going to last for the next 10, 15, 20 years, because the only way to fix the housing problem in the United States isn't just lowering interest rates, but it's also increasing supply. And the government isn't doing anything about increasing supply. They're mainly focusing on lowering rates, which will help a little bit. But again, it's not going to really help in a major way as much as we would have if we just increase the supply of homes, which is why buying a house is much more expensive than renting a house. And it's going to be this way for a while, which is a massive tailwind for the apartment REIT stocks. Now, rents have been booming in 2021, 2022. They boomed after the pandemic, and they were normalizing over the last 3 years. Even some areas in the United States, like in Florida, they declined in rents. In Texas, they declined in rent. trend. It's just normalization. And after 2025, 2026, 2027, they should go back to their historical average. And it's been happening. Like in Q1, the company grew rents 1.7%. In Q2 so far, it's 2.3%, almost double. And it's gradually improving. And 2026, 2027 is going to be much, much better. Now, if you look at the company's allocation, I like that they don't, as they're not all in the Sunbelt area. Like Mid-America apartment communities, they're all in Texas and all in Florida, which is great. And they have been facing massive net migration. But sometimes you have better rent stabilization in places like New York and even in California and other places, you have stronger rents. And those markets have been stronger than Florida and Texas in terms of a rental market over the last few years. While Texas was declining in rent growth, California and New York, they increased in terms of rent growth. So the company is much more diversified, but they are expanding more into Denver and Florida, Austin, Texas, and Dallas. Those are the growth areas. So the company is doing the right thing, and they're very diversified. Now, if you buy Avalon Bay Communities, you're getting a 3.5% dividend. Maybe not the highest dividend ever, but it's a good payout ratio. It's well covered. They're not gonna cut it anytime soon. One of the safest dividend yields you could have. And 3.5% is not bad. So you're getting 3.5%, but with the apartment REITs, you're gonna get much more AFFO per share growth than you're gonna get with REITs like VC and Realty Income. This is because those companies, they don't have 10, 15-year leases. They're not locked in at 2 and 3% rent escalators. They can take advantage of certain markets. If the housing market is hot, they can raise rents 5, 10, even grow 20% like they did in 2022. Sometimes it's a little bit slower like in 2025. They're only going to go 3%, but they're raising rents every single year. And they have control over their pricing every year versus companies, let's say like VC, where they have 20, 30, 50-year rent escalators where they can't really switch it too much. It's only based on the CPI. So this is why those companies have lower dividend yields, because they grow faster in AFFO per share. And the company is expected to get back to 6 to 7% in AFFO per share growth. I believe 7% will most likely be fair, especially if interest rates come down. Now, if we have 7% of AFFO per share growth and you have a 3.5% dividend, this is around a 10.5% annual return for just holding Avalon Bay Communities. And then you have the potential of a multiple expansion, where the company, if we go back to a 2018 multiple, it used to trade at 23, 24 times AFFO per share. Now it's trading at 19 times. So you're not only getting paid like 10.5% return while you wait with an apartment rate, but you're also getting the potential of a multiple expansion back to the mean, which is around 22, 23 times from 19 times, which would be maybe 14, 15% annual return. So again, the REITs will not give you life-changing returns, but as a setup over the next 6 to 12 months, relative to other things in the market, I'm seeing a lot of stocks move, a lot of stocks going up. But at the REITs, I'm not seeing a lot of action around them. And for me personally, I have them on my watch list, and I'm starting to get very, very interested. Now, the second one, which I also used to own, and it's also on my watch list, is Realty Income. Again, no action on Realty Income. And if I'm right on what I'm telling you in terms of interest rates coming down, hedge funds will be piling up in those REITs like never before. They're not going to remain flat forever, trust me. So I believe my upside potential will likely be conservative in terms of a multiple reversion, other than the yield and other than AFFO per share growth. But Realty Income has been flat for the last 5 years. It's a very good REIT, a little bit hated. People don't like this one, but I personally like it. But the main reason why people don't like it is because of their tenant exposure. Like they have 7-Eleven. 7-Eleven is an amazing tenant for Realty Income, but they have Dollar General, 3.3%, which is solid, but it's not really the best. They have Walgreens. Walgreens have been closing. Now they can sell them, they can lease them to someone else, but it's 3% of the portfolio. It's a decent chunk, but it's really no big deal. And they've been diversifying away from Walgreens. Walgreens used to make up I believe, 4 or 5%. So it's been going down as the company is diversifying away. Then they have Dollar Tree, Family Dollar, 3%, not the best. They have Wynn Resorts, 2%. This is a good one. Lifetime Fitness, gyms, and other things, and Tractor Supply, and CVS, and LA Fitness, Home Depot, Walmart, Sam's Club, 1%. So those are good tenants. And most of their tenants are really great for realty income, as they have 9.1 years in terms of an average lease term. And this is what I was explaining to you guys, where realty income, pretty much rent growth is predetermined. So they cannot decide to raise rents 10% this year because they're locked into longer term contracts. But a company like Avalon Bay Communities can raise rents 10% this year if the market allows it to do so. So this is why realty income will offer a higher yield than Avalon, but Avalon will grow much faster than a company like realty income. But what I like about realty income is the ability of the company to innovate and to find new verticals to reinvest the money. I mean, I said back in 2020 that this company is too large for a REIT, and there's no way they're going to keep finding places to reinvest this money and grow on AFFO per share. But I was wrong, because they went into the UK, a $9.6 billion TAM. Then they went in Europe. They went more into gaming, data centers, credit investments, and they kept expanding into new verticals for them to find ways to reinvest the money. They have some debt due in 2026, but they have a good credit rating, A-. They can refinance a little bit at higher interest rates, but it's really no big deal. I'm not too worried about realty income's debt. Now, to calculate the return of realty income, they pretty much do it the same way I do it. They take the dividend yield, and then they take AFFO per share growth, and then they get the total return, excluding a multiple expansion or contraction. Now, they said the historical average dividend yield is 6%. Currently, it's not 6%, it's 5.6%. So it's almost 6%. If they grow it next year, it could be 6%. So if you want to keep it simple, we could take a 6% dividend just to calculate it. But for AFFO, they said the average is 5%. I don't believe they're going to get back to 5% again. They used to grow 5-6% in 2018, 2017, but the company again is getting too big. Last year was 4%, this year is 1%. Next year is expected to be like 3%, 4%. So I would say 4% tops. So if we're getting a 6% dividend and a 4% AFFO per share, this is a 10% annual return for just holding a company like realty income. But with realty income, you have the potential of an explosive price movement because of how discounted the company is in terms of its average multiple or its mean multiple. The company right now is trading at 13 times. The mean was around 17 times, and it traded as high as 24 times. So if we're right about interest rates coming down, you're getting paid 10.5%, 10% while you wait for a multiple reversion back to 17, 18 times. To me, realty income is presenting an amazing value proposition. Like if I had a lot of cash and I missed out on the market and I'm not finding any value, I would be looking at the REITs. I think realty income is looking good. I believe Avalon Bay Community is looking really good, is now at a 3.5% dividend. If it gets to, let's say, a 4% dividend, for me, I might buy the stock again. I think it would be too cheap to ignore because I'm still finding other opportunities in the market, and I don't care too much about the dividend yields. But if I was a dividend investor, I think realty income looks good. I think Avalon looks good. And if we're right about interest rates going back, I don't believe the chart of Avalon is going to be like that a year from now. And I don't believe the chart of realty income is going to also be flat for the next 2 to 3 years. So there's definitely a very interesting setup. And that's just my opinion on realty income and Avalon Bay Communities. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.